In the last 24 hours, one of the biggest deals in the ETF industry has just been announced. Goldman Sachs is acquiring Innovator Capital Management for approximately $2 billion in cash and stock. This move instantly transforms Goldman into a dominant player in the fast-growing world of defined outcome and active ETFs. Let's break down exactly what this means for investors, for the ETF landscape, and for the broader institutional embrace of structured products. Welcome back to the channel. On December 1, 2025, Goldman Sachs confirmed it has entered into a definitive agreement to purchase Innovator, the pioneer of defined outcome, or buffer, ETFs. The deal is expected to close during the full second quarter of 2026, bringing roughly $28 billion in assets under supervision into Goldman Sachs Asset Management. For context, Innovator currently runs 159 defined outcome ETFs that use option strategies to deliver predefined levels of downside protection and capped upside participation over fixed periods, typically quarterly or annually. These products have exploded in popularity, growing at a 66% compound annual rate since 2020. Goldman's CEO David Solomon put it bluntly in the official release: active ETFs are dynamic, transformative, and have been one of the fastest-growing segments in today's public investment landscape. By acquiring Innovator, Goldman Sachs will expand access to modern, world-class investment products for investor portfolios. Innovator's CEO Bruce Bond echoed the sentiment, calling the deal a pivotal milestone and praising Goldman's track record of identifying major shifts in asset management. What does this actually add for Goldman? Right now, Goldman's US ETF platform stands at about $51 billion across roughly 50 funds. Adding Innovator catapults the combined entity past $75 billion globally and moves Goldman firmly into the top tier of active ETF providers. More importantly, it gives them immediate leadership in a category where Innovator has been the undisputed innovator for years. This isn't just about scale. Defined outcome ETFs are one of the few product types that have consistently pulled assets away from traditional mutual funds and separate accounts because they offer something truly differentiated: predictable risk parameters in an unpredictable market. And yes, for those following Goldman's crypto journey, Innovator also issues the QBF Bitcoin-linked defined outcome ETF, which uses flex options on spot Bitcoin ETFs to give investors buffered quarterly exposure to Bitcoin with a 20% loss cap. That product, along with the rest of Innovator's crypto-linked lineup, now falls under Goldman's umbrella, further cementing the bank's pivot from crypto skeptic in 2020 to one of Wall Street's largest holders of spot Bitcoin and Ethereum ETFs. Key executives, including Innovator co-founders Bruce Bond and John Southard, will join Goldman, along with more than 60 team members. The business will be fully integrated into Goldman Sachs Asset Management. Bottom line: this acquisition accelerates Goldman's push into high-margin, durable fee active ETFs at exactly the moment investors are demanding more outcome-oriented solutions. It also signals that the major wirehouses and investment banks are no longer content to let boutique issuers dominate the most innovative corners of the ETF market. We'll obviously keep a close eye on regulatory approvals and any product roadmap updates once the deal closes next year. If you found this breakdown helpful, please hit the like button and consider subscribing so you don't miss future updates on major moves like this one. Thank you for watching, and I'll see you in the next one.